let's kind of apply some of these underwriting concepts. Okay, so what I'm going to do today is let's start talking about taking some of the things we talked about yesterday. I'm going to give you guys some case studies, and then let's talk about what that looks like with and is my hold on, let me make sure my mic's working too, the good one here. Uh, so let's start talking about some of the underwriting themes here that we learned yesterday. So I'm going to give you guys a couple case studies. I'm going to give you guys one each, and then kind of tell me. You don't have to give me the exact carrier, but tell me what you would do and why. Okay. So Jason, I'm gonna go with you first. Let's say it's a 65-year-old had cancer 5 years ago and is just looking to cover burial. But also has a mortgage of $100,000. What would you do there, ideally?
Um, Final expense and mortgage protection. Is it called mortgage protection? Yeah, mortgage protection. Where I would send him would be American Amicable. Um, let's see. You said he had cancer in the past.
Yeah, he cancer in the past, 5 years ago. Let's say 5 years ago.
Yeah, I would do American Amicable because I think he's more of a higher risk, and I would do a final expense and mortgage protection.
Oh, okay, and what do you mean by final expense within mortgage protection? Can you got to give a little bit more clarification there?
Well, wouldn't that be two separate policies?
So what you would utilize is probably a final expense policy. Just I would do a bigger final expense policy because a mortgage protection is kind of a marketing term. So you would use a final expense for the mortgage protection. So you'd have to use a final expense policy, a larger one.
Okay,
You see what
okay.
I'm saying? Yeah.
Yeah.
Um, all right, cool. So Starla, I'm gonna do let's say a 30.
And
What were you gonna say,
oh,
Jason?
oh, never mind. Go ahead. I'm sorry. I
Uh
would say I was going to use American Amicable because through my research, I think they have can improve a little bit better. And I would send more of a healthier client or a younger, healthier client to more so like Mutual of Omaha or something like that.
okay,
Still
yeah.
learning,
No,
you
you're
know.
good. You're good. You don't have to find the exact product. You don't have to find the exact product. You know what I mean? All right. So as far as Starla, what would you say for you would be the like if let's say you've got a 32-year-old healthy $300,000 mortgage they just got has high blood pressure meds.
Just got diagnosed.
Just got diagnosed, yeah.
Um, well, with that diagnosis,
Hmm.
then they wouldn't be able to necessarily get the IUL or a term because of the diagnosis. So recent,
Hmm.
right?
Hmm. Yeah, so it would
So you'd almost have to just do final expense.
well, so with a 30, but a 30 something year old, right, would be fine if it's high blood pressure meds. If it's over, like if it's just a high blood pressure med, it's one, right? You see what I'm saying?
Right.
It's not like American Income Life. It's not like American Income Life where they don't cover a lot.
Yeah, that's actually why I came to wanted to be a broker was or work with a broker is because you can get more people covered.
No, of course. You can get a lot more people covered.
So
So I
you could just do a mortgage protection, which is a term, and you could probably even do an IUL as long as she could get approved with the high blood pressure. That's what would concern me. And it would be also what medicine she's on because and dosage, right?
Mhm.
Or do you guys not go by that?
It would be medicine. You would look at the medicine for sure, like what the prescriptions are and the dosage. And the other thing would be like, has there been any hospitalizations due to blood pressure? And are they compliant taking their blood pressure medications? But if that's all good to go, then yeah, you would you could just go do a term policy there. Okay.
Okay.
So again, just applying these concepts that we had from yesterday, okay? Um, let's kind of utilize let's say a final expense case here. Let's say they and you guys can work together on this, okay? Jason and Star, let's say they've got cancer 3 years ago, they're a smoker and they're type 1 diabetic. Um, and let's say they're looking for to cover just regular final expense. What type of policy, based on what we talked about yesterday, do you think would cover them?
Simplify issue, final expense.
Yep, do of course. All the final expense can be simplified issue.
Being that the what was it, cancer 3 years ago?
Yeah, cancer 3 years ago. Yep.
So anything over 3 years yesterday, you said do guaranteed issue. Oh,
Or click the clear choice final expense.
Yep. Clear choice final expense would be good. I would say though, do you think it would be level or do you think it would be
Graded.
yep, graded would probably be where they would fall there. Some places may take them level, but with all the health issues in the past, it'd probably fall within graded. Okay. Do you guys see how the pattern is here? Like the more severe it is, like obviously the less they're going to be able to get. Why is it that when someone's really sick, that the company like why is it that they do that? Like why does an insurance company ask all those questions and approve less and less based on their health? Because once you understand this,
Because
it makes it easier.
because
because
it's
they're
a
a
greater
higher
risk,
risk.
They're higher risk, right? So they're higher risk, meaning that they can't make as much money, right? They want to charge
right?
more for higher risk classification. So if we understand the healthier someone is and the longer they're going to live, the less the insurance company can charge for them to make the same amount of money and basically do $1 million term on someone who might for maybe 75 bucks a month because they're healthy. You know what I mean? So,
Hmm.
all right, let's kind of go forward here, kind of the next slide here. Sorry guys, my phone's going off today. All right, let's see. Why is this? Okay, so let's kind of work on term here. So term is obviously going to take more into consideration, right? So you've got they're going to need the driver's license, which is their motor vehicle report. That's going to be on there. They're also going to have, they're going to look at way more of the medications. What are the big things that they don't like to see on term, guys?
Cancer,
Cancer,
stroke,
stroke, heart attack,
And then severity of
depression.
Diabetes.
diabetes.
diabetes. Yes, Aurora, how's it
Yeah.
going?
Good morning.
Good morning. So diabetes, but what type of diabetes?
Um, Not the one that you're born with, so type 2,
No, it's type 1. Type 1
type
is
1.
because type 1 means that they're insulin dependent typically. or
Right.
type 2 with insulin. So they're really looking for insulin dependent diabetes. Okay. You can get it with some places, but they
Oh,
really can't have any other health issues. Okay.
okay.
So so let's say now if someone's a smoker, does it disqualify them from term?
No, but it's more expensive.
It's more expensive. Okay. All right. So we guys understand that's going to be more expensive in all walks of life, all different products. Okay. So let's say Shirley, I'm going to ask you a question here. Shirley, let's say the person is 48 years old and they're a smoker and they've got high blood pressure, high cholesterol, and they're on one depression med. Do you think they could still get term?
Um, no, they're probably
They well, your computer just shut out there, so I'll answer it. So they can still get term there. So it's all the timing on when they started these meds, guys.
um
Oh,
The
well, would
timing
it
of
depend
this,
on how long the term policy?
guys, is her internet being slow on our end too, or is it just me?
yeah.
It's everybody.
It is.
Okay, Shirley, I think you're delayed by about 10 seconds. So you can put it in the chat if you don't mind. Okay. So with the health timing is important there. So understanding like if they're a smoker is fine, but if they've got cancer, if they've got obviously the four I talked about, but if they've got like high blood pressure, high cholesterol, and they've got another health issue, as long as it's controlled and it's a certain amount of medications which you can put in the insurance toolkits, oftentimes they can still get approved for term. I'm not going to say it's going to be inexpensive because they're a smoker, but they can oftentimes get approved there. Okay. All right. So let's kind of
Okay.
look. What did you say?
Okay.
Yeah, so you can get a lot there. So again, health timing is so important. If they've ever gotten some sort of criminal record in the last 10 years, that they're going to take that more seriously on term policies. Just understanding what they have, when they got it, knowing the big ones that they don't like to see for term, so that would automatically disqualify them. And then if they have, a depression, how severe is the depression? If it's bipolar, no one for term that I know is going to accept bipolar. So understanding that term has it's somewhat lenient depending on the carrier, but there's obviously a point when it's like, okay, this person's pretty sick. They're not, they're not in the cover on Men's Health magazine or something like that, right? They're at that point you're looking closer to the final expense if they're not as healthy. Again, Starla, our term policies here with all the different carriers are going to accept more than even the final expense would at AIL. So just remember that. Um, just understanding the underwriting there, playing around with the toolkits, going onto the carrier websites, seeing what's changed. Again, 45 years old, Mutual of Omaha,
Pretty good.
Mutual of Omaha,
Oh.
and KC Life will accept it if they've got insulin over the age of 45 years old, and that's all they've got. So just see those little nuances, okay? Everyone kind of understands here with the term how it's different than a final expense, but you just got to ask more questions.
Yes.
Okay. Term two, just to understand here, term is to typically cover larger amounts of risk. So, for example, let's say they've got a $300,000 mortgage and they're 32 years old and they've got all this income they got to cover. That's where you're utilizing a term policy. Okay. All right, let's kind of continue on here. So, let's say like a borderline client, let's say they're 52 years old, they've got type 1 diabetes, high blood pressure, and high cholesterol, right? They've got a $58,000 left on their mortgage. Okay. Where do you guys think you would go here with that?
Whole life.
You could go final expense. Yeah. I'd probably recommend right off the bat with a borderline client. My typical idea is if there's someone that's like, okay, like it's close, like I might say, hey, I'm gonna try you with a term policy. There's like really only a couple places that may accept you. If not, I think we may have to go more of a like a whole life route. However, and then pitch it that way, kind of opening that door. I wouldn't just be like, oh, we're gonna go term and just assume it, because if they don't get approved, then you're kind of stuck. Okay. So that's what I would do with a borderline client, right? You're making it so that there's an option to go this door or that door. You may try a couple term carriers. If right off the bat they're getting declined, then you still got that door open for that final expense coverage. A lot of times, guys, I want to kind of, this is where I think it's important that a lot of agents lose sales is they go into the sales process, okay, and they get a decline and they talk to the client like it's the worst thing ever. If you were to go to, if let's kind of use going to get car to go buy a car, right? I don't know. Everyone here's gone to a car a lot, bought a car before, right? Everyone here? Okay.
Yeah.
Anyone here? Let's say you went in, you didn't have a great credit score, so they couldn't approve you for the car you wanted. I don't know if that's ever happened to any of you. If they came up, oh man, we just can't get you approved. That just I can't get it. It sucks. What are you gonna do? You're probably gonna feel deflated and almost not even want to buy a car that day. But if you come out, hey, unfortunately, I got good news, I got bad news. I'm gonna give you the bad news first, and I'll go with good news. So they don't even have a chance to like have an opinion. You just go, hey, unfortunately, I couldn't get you approved for that Dodge Charger you wanted, Jason. However, what I can do is I've got something that's also pretty sporty, and I can get you a payment that's around the same for something that's also sporty. Okay, how about we look at that? Because I want to make sure that you walk out of here with a car. That sound fair?
Yes.
See how that's completely different? It's the same outcome from the original application, right? And obviously it's a financial application versus a health application. But do you notice how it's spun in a positive direction? We're moving the sales process forward. And that's how you move the sales process forward in the insurance field. It's like, hey, unfortunately, you got declined by term. I don't even tell them why they've been declined unless like it's something that's like very clear they didn't tell me. It's like, hey, I see this that came up in your file. Just tell me that so I can find a place that covers you. My job is to go to bat for you. That's why we have so many different carriers. And then they're not even going to really have, I don't get a lot of pushback on that because they're like, oh, okay, yeah, cool. And then you just keep going. Make sure you guys do that. I see so many agents who lose policies because they're so afraid to just tell them that, or they're so afraid to tell them in a positive way, or they're so afraid that they're going to be like, oh, I can't get anything, that if they just came with it in a positive way, right? That it's not a bad thing that they got declined. In fact, it's a takeaway. Now they understand, hey, this isn't like going to the store and getting milk. You actually have to get approved for this. It's a takeaway. And then utilize that to continue the sales process forward. You end up with a happier client, right? But if you just say, oh, they've been declined, you know what they're going to do? And if you haven't moved that forward, they're just going to find someone who's going to approve them. And if you're not going to do that, then they're going to find someone who is, right? So love who you're with. Take the time. Make it positive, okay?
So Cameron, I agree with you totally. Because as I said, I do have a 9 to 5, and there are some instances where I do have to give unpleasant um, information. And actually, what I usually say to them is, here's a situation. And in this case, I wouldn't tell them why they got declined. And
Mhm.
I'll just say, hey, this is what I can do. This is what I can control. And I let them, we move on with the situation. They already know, I'd say to them, hey, your insurance in my world right now, I work for a DME company, and I'll say, hey, your insurance did not cover this amount for you. However, this is what I can control, and this is what I cannot control. And we move straight on forward. Like, I don't make them feel bad, because at the end of the day, there are certain things that we can control, and there are others that we can't. And it's always good to, sandwich the bad news in the middle. Like, you give them something positive to go away with. Hey, I can't give you that car that you wanted. However, I do have something similar there too for you. And we move on
Exactly.
from there.
You're the last thing they hear is positive, right? The last
Yep, absolutely. Yep, yep,
100%.
yep, yep.
So I love that. Thank you, Shirley. I love that. I think again, guys, it's well, you guys ever heard the saying, you get more with honey than you do with vinegar? It's the same thing with this. Like, if you're providing value to the client and making sure that they feel that they're taken care of and you're not panicking, right? Um, everything's gonna be all right. They're gonna continue to want to work with you. They'll continue to find a solution, especially if they're really sold on it. Now, if you have someone they get declined and they're like, actually, never mind, you didn't really sell them on it. they weren't sold them to begin with. They were probably going to cancel it anyway. But if they're like, yeah, let's continue, which most of them are, then you just continue the process until you find a carrier that covers them. And then you obviously ask more questions, like what is it that could come up? And oftentimes they're like, well, I got into a car accident 3 years ago when I was on oxycodone. Okay, well, that would have been nice to know. Well, I have diabetic neuropathy. I have only one leg. And I've heard that, by the way. I've had people, well, I didn't know that. I didn't know that counted. Well, you're missing a leg because of diabetic neuropathy. You'd think that they would think that, but sometimes people always perceive themselves as healthier than they are. Just remember that, guys. They always perceive themselves as healthier than they are, so they're gonna be like, "Oh, I didn't know that counted." So just make sure you ask the questions, okay? And different carriers have different outcomes. Any questions on this?
No.
No? Okay. All right. All right. Let's kind of do a group decision activity. And Quentin, Aurora's been in the space for a while, so Aurora's gonna come in here sounding like she knows this. She knows a lot of the underwriting. So if you guys are thinking, wow, she knows a lot, it's because she's been doing this before. Quentin, you're new to the life insurance space, or you've been doing this a while?
I am pretty new to life insurance.
Okay, so it sounds like if I'm you, right? Because we'll get all these recordings. I'll make sure that I'll send them to Troy so we can get them all processed for you. So you're gonna have to watch tomorrow too. But for those of you who've been in here or feel comfortable, I'm gonna give you a couple case studies, and then let's kind of work together here. I'm gonna be hands off, and then I'll tell you what I would have done or if it's great by the end. Okay, so I would write this down. Okay, so let's have a 46-year-old married to a 42-year-old, so 46-year-old male married to a 42-year-old female. The 46-year-old has high blood pressure, high cholesterol, and the 42-year-old female has the 42-year-old female has type 1 diabetes and anxiety meds. The mortgage amount is $300,000. What would you guys do to set them up, and why? And you guys can talk amongst yourselves.
What's their income?
Their income. That's a good question. The income is the 46-year-old's income. The male is 110,000, and the females is 38,000. Here,
What was it?
38,000.
Does it matter where they live?
You stay Ohio. Doesn't really matter where they live now.
Okay.
Would it matter what anxiety med they were on?
It would matter, but let's say it's minor situational anxiety, like a Prozac,
Okay.
like a fluoxetine type thing.
Aries.
Type 1 diabetes means insulin dependent.
I forget, what's the maximum for a term policy? I know there's 5, 10, and 20. Is that the maximum
30.
years?
We go up to
30 is
actually,
the
we have a
maximum?
product that goes up to 40 years, but typically we do around 30 years.
Oh, okay. Okay.
Well, she wouldn't be eligible for a term because she's got type 1 diabetes, right?
Mm-hmm.
So you'd almost have to do the final expense for her.
Yeah, that's what I saw too.
And how long ago was the male diagnosed with the high blood pressure and high cholesterol?
Male was diagnosed at age 42.
Okay. So he's been on the medicine and stuff for a while. So
Yep, it's well regulated.
he
He's compliant, never been hospitalized for anything.
okay. We could actually probably get him a term then.
You definitely could get him a term. Give you a little. Definitely could get him a term. No questions asked there.
Pardon?
You definitely could get him a term. Definitely. He definitely can get a term.
Right. Get him a term for the mortgage protection and then maybe some final expense as well. So he's locked into that rate.
Mm-hmm. Yep.
So when the term expires, his bill just goes down and he's still covered.
And she could probably have a small final expense policy since she's not covering his income, essentially.
So yeah, you would definitely want to put more coverage on him to
Yeah.
help support her.
Mm-hmm.
So definitely get him a high end, at least 400,000, you would think, if they have
Yeah.
300 left in their mortgage.
So what do you
Gives
mean?
her 100,000 until she can figure out what she's going to do to replace the income.
That's only 1 year's worth of income.
Right. I mean, would just that be the absolute minimum would be the 400,000.
Yeah.
That would make sense.
I would say if you're going to mortgage protection, the absolute minimum is covering that full mortgage. Absolute minimum. Because at least there's something, but I agree with you. I'd like to see, and typically you'd like to see 5 to 10 years of income covered after,
Right.
right? Typically. So that's kind of your second level.
5 to 10 years. That's a lot, actually.
You'd be surprised if she's only making 38 grand a year. She doesn't, what is she, like, is she a stay-at-home mom? Why is she living at 30? Does she have a low, like in this,
I mean, type 1 diabetes and anxiety makes sense. No, just kidding.
right? So what would you do for her though? Because let's say, guys, I haven't asked, she's a stay-at-home mom. She got 2 kids. That's why she makes more.
Um,
But what
I
what's what
still
well,
do final
she
expense for
doesn't
her.
qualify for term, right?
she's not going to get a term policy if she's type 1 diabetic before 42 with anxiety. Maybe with Foresters if she's lucky, but
Mm-hmm.
pretty unlikely. Let's assume she doesn't here. Probably have to go final expense policy.
And depending on the dose of
Yeah, I was
insulin,
thinking
that
like a
would
smaller
determine if
final expense. Sorry.
it would depend on if it was level or graded or whatever, right?
That she's going to be level with the type 1 in this particular case because if it's insulin and anxiety, there's going to be a couple carriers that would cover her final expense. They're not going to cover her term. So if you guys had to come up with a final solution here, like they're sitting there waiting on the phone for you, what are you coming up with a solution? At least just one. We don't have to do 3, just one solution. You don't have to give me the company, you just have to give me an idea here.
Term for male, final
yeah.
expense for the female.
Okay, and how much term would you pitch to the male?
300,000.
I'd probably
I
have
would say 600,000.
600,000, probably what I would do. 40,
Yeah.
but 300,000 is the least amount you want him to get, Jason. So like, if they're like, well, we can't afford 600,000, then you go down to 300,000. What are you guys thinking for the 42-year-old? How much coverage and what are you doing here there?
Final expense. I mean, at least to cover her funeral and a little bit for after. So like a $100,000 policy.
$100,000 policy.
Probably at
I
least,
would say 50.
I
I'd
think
say,
$100,000 final expense is going to be very pricey. So I think Jason
I'd say at least 25 to 30,000.
minimum. Yeah, I would do 50 with a $50,000 accidental. That's what I would do. A final
Okay.
expense. So
Okay.
I think you guys were all kind of on the right page. Do you guys
Okay.
notice what you did there? What you did there? You all discussed it. You're asking about the meds. This is how you need to think. It's not about the outcome of what you came up with because you're gonna have the tools. You have less tools in this activity than you would in an actual sales process. But you guys all were like, well, what do they have for meds? What do they have for the? That's the way you have to think. If you can do this and think and kind of come up with something that's remotely close, the rest is the real fun stuff, which we'll go over Wednesday, Thursday, and Friday. The sales process, setting appointments. But if you guys, great job there. We discussed the different options. We went through why is it this? What meds are they on? Why that med? What you know what I mean? So you guys are able to figure that out. Okay, so that was good job. Any questions on this activity?
Nope.
Okay. Okay. Give me. I'm gonna have you guys tell me what you guys would say key lessons from this are from applying these
Say
underwriting.
the what?
The key lessons. What have you kind of figured? Like Jason, what's a key lesson you're taking away from this?
Ask as much questions as possible, especially in regards to their health. And don't, I get what's, how I would say this. Don't count your client's pockets. I mean, that's personally what I mean, to see what they qualify for. But I ask a lot of questions and get in detail. Don't be afraid to ask questions because the more questions that you have will help you with the underwriting process.
100%. 100%. Starlo, what about you?
The more details you have, the better you can help your client. Like, okay, she's got anxiety, but when did she get anxiety? When did she start taking that medicine? The more details that you have and the better rapport, honestly, that you have with someone and to give them options. Now, I don't know, I guess we'll get into that Thursday and Friday, but I've always done the options. You can have gold, silver, bronze, this, and it comes with this, and it comes with this, but
For
it covers
for
all of
sure.
it. You know what I'm saying?
I do. I think you have to come up with 3 different options, but you have to.
I'm
So
gonna tell my husband bye. He's getting ready to leave for work.
All right, bye, husband. What you do is you have your 3 options, right? So let's say you come up with like the general idea, like you guys did in that group takeaway, right? Or that group training there, this case study. What you're gonna do there is now that you guys had an idea of like, okay, I'm gonna do a term for her and a final expense for her, or for him, I'm sorry, a term for him, final expense for her. Then you take that and you just like have the coverage amount, the highest coverage amount. It'll cover this, and this. Okay, it's gonna cover 5 years of income and the mortgage for the term. The second option might be 1 year of protection for the term, the income and the mortgage completely. And the final option for the term may just cover the mortgage. So you're getting takeaways as you go down. And then for her, it might be like, covers this, and this, like debt, whatever it's going to cover. It has accidental. The second one's a little bit less, covers this, year of childcare. And the third one's like bare minimum, just covers the burial. You know what I mean? So you're having those takeaways, but you have to understand where you're going to go with them before you can create a plan, right? Okay. Quentin, what have you taken away so far?
My main two things were one is it's okay to be practical, but stay on the positive end. Whereas, and what I mean by that is where it's like, for example, she has type 1 diabetes, so we know, she's not going to get term, but we shouldn't stay in that negativity to where this is what we can't do for her. We should stay on more, this is what we can do for her. And then that leads into the stay positive as well, because you want to be able to do right by them. Just in case, if we were in that situation, we would want somebody to be like, oh, yeah, they know I only could get 25,000, but sure, I want more than that. I want the best for my family, after I'm not on this earth. So I would always say, focus on what you can do and also lean into more of the positive, because we're already talking about a negative subject by nature anyway. That's just me though.
Mm-hmm. Okay. Aurora. I mean, this is a lot of stuff you probably know already, but
No, yeah, definitely. But that was really good, Quinn. I love that. Everyone kind of took little bits and pieces of what I was already gonna say, but yeah, just kind of being fluid with everything and um like Quentin said, not focusing on the negativity of the business side of it, but um also being really knowledgeable in the products and knowing what you're talking about.
so
Having that confidence. So I think that's really important too.
for sure, because it makes your sales when you go into the sales process, which we're going to get into tomorrow and Thursday, it makes that a lot easier. Okay.
Yeah.
Shirley, what is your kind of big takeaway? One big lesson you would say from this today?
So, okay, so you didn't mention it, but is the thought to find out, hey, what do you want to accomplish from this? What do you want to, what is it that you want to accomplish? And he says, I want to cover my wife and myself, and do both of them. The ultimate goal is to make them comfortable in what they're getting. Nobody said that, but that's what I'm always thinking, that you never want to put a person in a car that they can't drive. You never want to put a person in a car that they can't afford, because at the end of the day, they're not going to make the payments. For this patient, this client here, we want to make sure that it fits their budget. Well, as they say, funding, that they're able to fund this insurance plan for both of them,
For sure.
as
I
well
think
as
this
me.
is I just to interrupt real quick. I think this is more sales stuff though you're talking about. When we're talking about like of course we're gonna ask the need and figure everything out, but like let's say Shirley, let's say you call me up, say Cameron, I want a Lamborghini. Great, Shirley.
Okay,
Do you have an 850 credit score and $3,000 a month you can allot just to cover the cost of the Lamborghini? Just to qualify for the Lamborghini. You may want a Lamborghini, right? You got to qualify
right.
for the Lamborghini. So that's why we're going over the qualification process. I agree with you, and we'll go over that in later lessons. But the point of these first 2 days of the training is if they don't freaking qualify, but they have $1 million mortgage, how do we find something that can help them by understanding the underwriting? Because if you don't understand